I'm Laura Prescott, licensed insolvency practitioner and CEO of Debt Movement UK, and I've been invited to speak to you today on the topic of personal insolvency. Throughout my 15 plus years in the industry, starting out as an insolvency administrator, drafting annual reports manually on Word, I know that insolvency practitioners are no strangers to compliance and regulation. It's something that's embedded in our very makeup, no matter our regulatory body or area of expertise in practicing insolvency. We strive to adhere to the standards of the Insolvency Act, rules, SIPs, guidance and policy updates, although there's so much of it and so many changes that sometimes it's hard to keep up. And let's face it, we've all been challenged over the last 18 months in ways that we never even thought probable or possible in the wake of the COVID-19 pandemic. Mobilising an entire workforce to work from home during the first and subsequent national and local lockdowns has been no mean feat. It has tested our IT departments and services in ways they wouldn't have envisaged, and we have found new ways of meeting and collaborating throughout the globe. No longer required to travel, we can accomplish a great deal through Teams and Zoom meetings from the comfort of our own home, and with one of the most used phrases of the last 18 months being, "You're on mute." Amidst all of that within the personal insolvency space alone, there's been so much happening that when you really sit back and consider, it may actually surprise you. I wondered whether this newfound ability to draw relevant stakeholders together more easily, virtually, has increased the pace at which such change is now able to happen, and whether this is likely to be the new pace moving forwards. I'll discuss today whether the consultation is really key to implementing better policy change for personal insolvency professionals as the landscape continues to change, and whether it is a waste of already stretched time. And finally, what's next? Predictions for the future of personal insolvency. It is said the journey of 1,000 miles begins with a single step. There's been much change within corporate insolvency in recent years, and now it seems the attention has landed on the personal insolvency sector. I'll be talking today about some of the changes that have already affected the personal insolvency sector in 2021 and those that are set to do so in the near future. And this is by no means an exhaustive list, we'd be here all day, but rather an overview of some of the more influential areas that will have impacted our systems, policies and processes for insolvency practitioners during 2021 and what's known to be coming down the line for the last quarter. So, kicking the year off in January, the consultation on DRO eligibility criteria opened, enabling responses to be provided on the suggested changes to monetary limits, the purpose of which was to make the debt solution more accessible to those in financial difficulty. With no changes having been made since 2015, this year seemed as good a time as any to review the eligibility criteria. Was this born out of the financial distress felt by so many during the 2020 COVID lockdowns, or was it always envisaged to take place in 2021? You decide. Consultation ended the following month, and I'll talk a little later about the impacts of the responses received. But also in February, the Insolvency Service published guidance for insolvency practitioners on advertising standards. This guidance will no doubt have caused a review of existing websites, including those of introducers where applicable. If not already in place, it ought to have highlighted the need for ongoing reviews of such sites and any other advertising medium used by your firm or any firm that provides work to you. And finally, for February, a busy month for one so small, the Woolard Review was published, in which it stated that the IVA market was broken. Controversial statement, not necessarily welcomed by insolvency practitioners who specialise in the IPA market, and dare I even say the IPA, who implemented the Volume Provider Scheme in 2019. Of course, I can't speak for them, but their website will say that the scheme covers 68% of the IVA market and was set up in response to the rapid development of that market. Their website states that it strongly believes the Volume Provider Regulation Scheme, a first in the insolvency profession, will deliver lasting confidence in the personal debt solutions market. It says it provides some of the closest scrutiny seen in financial services, and as a member of the scheme, I can attest to that. Monthly data provision, monthly call listening, and up to 4 regulatory reviews per year is certainly not for the faint of heart. So over to March, where the Insolvency Rules consultation opened, interestingly, to find out if the changes made in 2016 had the desired effect. I often find that legislative changes are made with perhaps the right intention, but the unintended consequences of implementing the changes operationally can cause more headaches for those that have to adhere to them, for those practicing both personal and corporate insolvency. The following month, the new revised SIP 9 came into effect. Whilst the majority of the IVA market are now on the fixed fee model, and the changes as they relate to disbursements would not create much of an impact, not all cases are proposed or approved on this basis, and therefore consideration to the revised SIP ought to have been given. Whilst I'm sure that you've already done so, a documented policy may well be helpful when it comes to SIP 9 and the fees and disbursements drawn by the office holder. In May, the long-anticipated breathing space came into force. This will have meant a rollout of changes in script, process and documents, with training required for staff to make sure they knew what breathing space was, and that while speaking with potential clients, it was confirmed they were aware of breathing space as an option, so they were making an informed decision about their chosen debt solution. In addition, the FCA's consultation on a new consumer duty opened. Whilst not personal insolvency specific, as we well know, the FCA does impact the personal insolvency sector quite heavily. In fact, one of the recommendations in the Woolard review was that the FCA must coordinate with insolvency regulators, the Insolvency Service and the Accountant in Bankruptcy to ensure that the multiplicity of regulators does not impact the consumer outcome. There's been talk for years of a single regulator to cover the personal insolvency sector, and often one finds themselves in a triply regulated situation. Take the case of an insolvency practitioner who administers trustees, for example, authorised and regulated by, let's say, the IPA, and subject to their volume provider scheme, as 54% of the trustee market is, bringing an already enhanced level of supervision. But not only that, the insolvency practitioner is subject to review by the accountant in bankruptcy, and where the insolvency practitioner provides whole of market advice rather than in contemplation of an insolvency appointment under the FCA's exclusion, they will also be subject to FCA's regulation for the provision of such advice and ensuing recommendation. June saw the implementation of the revised DRO criteria in England and Wales. Again, this will have necessitated another change in scripts, process and documents with training required for staff. What has not been made clear to insolvency practitioners is what is to be done for those cases that are already in an IVA that could now possibly fall into the new eligibility criteria. As the disposable income threshold is only £75, this should be few and far between. However, where there has been discretion applied to reduce contributions or there's been a change in circumstances affecting affordability, it becomes a necessary discussion. Most IPs are reviewing their cases in line with the anniversary, following an income and expenditure review, and having a discussion at that point to determine whether the IVA remains a suitable solution. Whilst many IPs aren't able to provide advice under FCA regulation and therefore recommend a DRO, a cautious approach should be taken in any event, as it certainly wouldn't be in the client's best interest to fail an IVA, enter into a DRO, their circumstances improve in the 12-month period, leading to a revocation and liability then for the full debt plus interest. Nor would that be in the IP's best interest, as it could ultimately lead to a disgruntled ex-client making a regulatory complaint. In other news, in June, the bankruptcy guidelines were updated on the Insolvency Service website, providing useful information for debt advisors when looking at what the OR would expect to realise, and therefore allowing insolvency practitioners who are acting as trustees in bankruptcies to adopt a similar approach. The consultation on the insolvency rules also closed this month. Fear not though, if you missed out on the opportunities to respond to the DRO consultation or the insolvency rules consultation or the FCA's consultation on a new consumer duty which closed in July, because another consultation opened up this month to fill a gap. Access to cash consultation. Again, not insolvency specific, but certainly impacts those working in the insolvency profession. Many people on a budget like to use cash as they can monitor their spending easier than using their card. And I remember as a child going to the shops with my mum, she would actually tally up her spending each time she put something in the trolley because she used cash to pay for it. And if she was caught short at the end, she had to sacrifice something and put it back. I genuinely believe those days are long gone. We've evolved now into a much more cashless society. With the advances of contactless payments, the limits seem to increase further, the ability to pay on our phone, cash is very much a thing of the past. Even before the pandemic, local branches were being closed down. So whilst there might be cash machines dotted about here, there and everywhere, the ability to actually go into your own bank might be prohibitive. At a recent MALG forum I attended, it was remarked that tangible cash is how children learn the value of money. Therefore, it follows to reduce access to cash would hinder the rising generation. So reflecting on this, I enlisted my 13-year-old son to pick up some essentials from the local shop. I gave him my card to use, which was brave indeed, but he's sensible though. So I knew that armed with a small list, he'd be fine. It would be well under the contactless limit of £45, so off he went. Proud as punch when he returned with all the items on the list. I asked him, how much did you spend? And he didn't know. And therein, I believe, lies a significant problem. This consultation is open until the 23rd of September for those who wish to respond. Just last month saw the IVA protocol come into effect. Whilst the draft had been released some months prior, as ever, there were inconsistencies and ambiguities that required clarification. True to form, the Insolvency Service published Dear IP the Friday afternoon before the protocol was due to be implemented on the Monday. Changes to the protocol again required amendments to SIPs, scripts, documents, systems, processes, so it was no surprise to hear that a number of IVA providers in the volume market had not embarked on any changes ahead of clarification from the Insolvency Service, and it was therefore delayed. That's 3 changes to scripts, processes and documents within a 4-month period, certainly keeping training and compliance on their toes. Not only that, another consultation opened in August on SIP 3.1. For those that specialise in the IVA market, SIP 3.1 is the backbone of our work and sets out the requirements for the provision of an IVA from initial contact right through to completion, with emphasis on ensuring the debtor has made a fully informed choice before deciding whether an IVA is the right solution for them. As mentioned earlier, the access to cash consultation closes on the 23rd of September, so there is still some time if you wish to respond. Now, as far as we know, the universal credit cut of £20 per week is due to come into effect at the beginning of October. You'll have no doubt seen plenty of media coverage, together with petitions, open letters, blogs regarding this, with the cut being cited by Joseph Rowntree Foundation as the biggest overnight cut to the basic rate of Social Security since the foundation of modern welfare state. But even before this change was announced, the Money and Pensions Service estimated that around 3 million more people than before the pandemic will need support with their debt problems by the end of 2021. With the extension of furlough schemes beyond the initial deadline might have been pushed down the road, certainly this change is set to bring about an influx of people needing assistance with managing their debts, as well as impacting those who are already in a solution. And as for the rest of the year, I'd say after all of that, we deserved a rest, but I'd no doubt there'll be more things released. What we do know already is that the SIP 3.1 consultation closes in November, and the COVID IVA protocol is expected to end in December. Of course, this has been extended a few times already and is driven largely by the pandemic, so it's anyone's guess whether this will be extended into 2022 at the moment. A busy year indeed, as you can see, and as I said earlier, that's not even an exhaustive list. So, is consultation key? A wise person knows that there is something to be learned from everyone. How better to learn and improve than to collaborate with like-minded individuals who work within the same sector and understand the process and operational aspects of the profession and what impacts would be felt where change is proposed, including the unintended consequences of such a change. That being said, Ken Livingstone once commented that consultation is a good thing when people agree with you and a waste of time when people don't agree with you. So what exactly is the point of all these consultations? Do our opinions even count? Is it worth the time reviewing the proposals that have already been through the rounds of deliberation to get to the point of consultation and putting your 2 pence in? Or has the decision already been made and the consultation process is just a formality, a public show? With 5 consultations on areas that might have impacted personal insolvency identified in the last 9 months, And there'll have been more that have already happened, more in the pipeline that I could have highlighted. That these weren't all insolvency specific, and it does take a keen eye to keep on top of them. Thankfully, there are many that do the heavy lifting for you if you subscribe to their mailing list, so you can find out all about them. So what is the point in consultation? As we're at a coalface, so to speak, we understand how policy decisions made by others who are not always practicing insolvency practitioners significantly impact our operations. And as I mentioned earlier, in the space of just 4 months, there were 3 instances of necessary script, process, and document change with the introduction of breathing space, the amendments to DRO eligibility criteria in England and Wales, and the new 2021 IVA protocol. Now, not everyone will respond to consultations. There is, after all, plenty to keep us occupied on a day-to-day basis as insolvency practitioners, but I do believe it's important to take the time to consider and respond if we want to continue to shape our profession and have a voice. Formal written public consultation will often be an important part in the policy-making process. Consultation makes preliminary analysis available for public scrutiny, allows additional evidence to be sought from a range of interested parties so as to inform the development of policy or its implementation. So it's really important that we consider our thoughts and our opinions. So the DRO consultation is one I'd like to draw comparisons on, because that being the only consultation that's closed and decided upon and implemented so far this year. So as you'll know, the consultation proposed to increase the total amount of debt allowable from £20,000 to £30,000. It also proposed to increase the allowable value of assets from £1,000 to £2,000, but it didn't propose any change to the items excluded from this calculation, nor anything to do with the vehicle limit. It also proposed to increase the level of allowable surplus from £50 a month to £100 a month. And following consideration of the 148 written responses received, the government pressed ahead with 2 of their 3 proposals, amended the 3rd and added the 4th, being the increase in the vehicle value limit. So the increase of total amount of debt was allowed to £30,000 as proposed. The increase in total allowable assets owned by the individual was increased to £2,000 as proposed. The extra addition was the increase in the domestic motor vehicle, which was £2,000. The change was to increase the level of allowable surplus income from £75 from the proposed £100 per month. Some might say that this was a win in terms of the consultation, depending on their views, but others, not so much. So let's look at the evolution of the DRO. We can see that it has evolved, and even though there may be some people that say there's barriers to entry, it is certainly more accessible now than it was in 2009 when it was first implemented, with a value of assets of just £3,000, with total allowable debts of £15,000. So when we look at the consultation responses received, the 148 responses, it's no surprise that the debt advice sector provided the most responses. One of the responses included in the 121 being a coordinated response with 182 signatories. The Insolvency Service noted in their summary that whilst the majority of those responding supported the government's proposal to raise the monetary limits, the responses were generally polarised between 2 positions. They said stakeholders from the debtor and academic communities put forward strong arguments for the government's proposed increases to the limits to go further, allowing more people to access the DROs. They felt this would help address the possible impacts of the pandemic on individuals' financial situations. Equally strong opposing arguments were put forward by the creditor and insolvency practitioner communities that some of the proposed changes went too far. There were concerns that they could distort the personal insolvency regime by making DROs inconsistent with other insolvency solutions, and that the proposals undermine a core principle of the regime that those who can pay their debts should do so. Given the apparent polar opposite opinions, what's surprising is that only 8 responses were received from the insolvency practitioner profession, representing just 5% of the response rate. Not only that, of those 8 responses, they included responses from R3 and the IPA, leaving only 6 responses from IPs themselves, which is representative of 4% of responses received. A total of 24 responses between creditor and the representatives and the insolvency profession were received, who, according to the Insolvency Service, again, were greatly opposed to the views of the remainder of the debt advisor community. So whilst the Insolvency Service didn't publish every response received, a summary was provided, and there are some companies who publish their response on their own website or shared on LinkedIn that may be of interest to those in the personal insolvency sector. And as you can see from here, there are some varying views. CAP produced an informative report in February 2021 called Simplify the Solution, which formed the basis of their response. It highlighted that over the past 2 years, 37% of their clients who pursued bankruptcy only failed to meet the eligibility criteria due to the debt level. And of that, 55% was made up of individuals whose debt level was between £20,000 and £30,000. So just going through some of these on the slide now, there were some areas where they wanted to increase the debt level to £50,000. You can see that CAP put that through. To amend the debt level to £25,000 was another suggestion from Mazars and UK Finance. There was an overwhelming support of raising the vehicle threshold to £2,000. You can see that there. And also a suggestion from Step Change and Money Advice and CAP was to allow pre-existing debts to be added to a DRO if missed. Now, Step Change did go a little bit further, and what they said is that a 10% discretion was to be permitted if the missed debts are added that increase the debt over the threshold. We do know as well from the review of the Woolard review that the application fee could be seen as a barrier to entry. And so there were some comments regarding the application fee from both Step Change and R3, who suggested that it should be reduced to £50. CAP Step Change also suggested that the monetary criteria should be reviewed every 3 years, as it has been the same since 2015, whereas the Money Advice Trust did go a step further to say that it should be an automatic annual uprating of eligibility limits. So it is obvious from reading some of the responses from the insolvency sector and then having discussed the matter with the IPA during volume provider meetings, the most controversial proposal in terms of the impact to the insolvency profession was the proposed increase in surplus income from £50 to £100. The statement from the Insolvency Service was that creditor organisations and the insolvency profession were strongly opposed to this level of increase. But I do think, however, that it's fair to say that the middle ground has been formed with the provision of the £75 disposable income. Published in the June Insolvency Practitioner article, the IPA said, in responding to the consultation on the plans, the IPA conveyed that the proposal to increase the monetary limits to £100 a month would likely lead to a significant drop in individual voluntary arrangement numbers and creditor losses as more people become eligible for DROs. Whilst the impact at £75 per month is significantly less, we are urgently working with the Insolvency Service to understand the practical applications for existing IVAs and will update members accordingly. Unfortunately, despite this seeming level of urgency published in June, we are still waiting for formal direction on this matter. So what's next? Peter Drucker said that the best way to predict the future is to create it. This year has seen a lot of focus on the personal insolvency landscape. There is more to come, with a number of consultations open for your input right now. And it is one thing to complain about the way things are and how it needs to change. When given the opportunity to shape the future of insolvency in the form of consultation, we can either voice our opinion or we can say nothing. But I believe that saying nothing really helps no one. Hopefully, my overview today of the DRO consultation has allowed you to see that actually change in the landscape of personal insolvency has already begun. As in the case of the DRO consultation, every opinion has a place at the table, and whilst they might not all be followed, they are at least considered. So the SIPS 3 consultation that is open now. We all know that SIPs are not legislation, but insolvency practitioners must comply with the principles contained in them. The IPA and the Institute of Chartered Accountants for England and Wales' statements on their website are very, very similar. But as the IPA point out in their explanation, it is a matter for disciplinary or regulatory action if SIPs are not adhered to. Now, given that SIP 3.1 is, as I mentioned earlier, the backbone of personal insolvency markets so far as it relates to IVAs, specifically impacts insolvency practitioners, their scripts, processes, policies, and documents, I would expect to see a higher level of engagement from insolvency practitioners than the number of responses seen in the DRO consultation earlier this year. So some of the changes within the consultation, these are just a few of them that I have highlighted, are to widen the scope of an insolvency practitioner's remit to include a review of introducer advice. Now, over the last few years, there's been a shift in terms of IVA clients' routes to market. Insolvency practitioners, who, as we know, are heavily regulated individuals who have studied for, successfully passed their personal exams, professional exams, usually with a wealth of experience behind them, were only authorised to provide debt advice in contemplation of an insolvency appointment, paving the way for a different route to market for individuals desperately in need of debt advice. Enter FCA-regulated advisors and the tug-of-war that ensued. Many debt advisors cited FCA authorisation as the reason for not providing call recordings to insolvency practitioners who are working hard to keep to their own regulatory requirements. Now, I'll caveat that to say that there's many FCA-regulated debt advisors who are incredibly transparent, who would provide any information, including call recordings, to insolvency practitioners on request. But still, not everyone follows that same ethos. Within the Woolard Review, it was made clear that the multiple regulators covering different aspects of debt advice and debt solutions should collaborate to ensure that they are not contributing to divergent outcomes for consumers who are in financial difficulties. This requirement now being embedded into the SIP does provide more weight to insolvency practitioners' requests that may have fallen on deaf ears in the past, with debt advisors hiding behind their FCA badge. But what it also does is firmly place the responsibilities on the IP's shoulders, which will likely impact the IP firm, who are then having to incur more cost in the form of quality assessors to ensure standards are met from introducers. Additional aspects to take into account are to avoid generic explanations, complete identity checks, and receive authority from a third-party introducer, including additional items in the proposal itself, including specific identifiable risks of failure for that particular IVA. Now, in reality, many of these amendments are already common practice among those within the personal insolvency sector, specialising in IVAs. But some of the changes might have unintended consequences. So let's take, for instance, the requirement to complete identity checks and receive authority from a third party whose income is taken into account for the purpose of household income and expenditure. So is this to extend to a child who pays board and lodging whilst residing at home? And how would an individual whose partner is unaware of the extent of their indebtedness feel if requested to provide ID and consent in order to complete a household income and expenditure, as in reality they don't separate their finances? Would this be a barrier to an otherwise perfectly suitable solution, or will we see more of 50-50 splits on expenditure items, which might not actually be a true reflection of actual circumstances? Now, I do agree that this is an area that requires improvement. Too often a partner's income can be inaccurately recorded, but I do think that wider thought might need to be given on how best to approach this. The definition to the legal, deviation to the legal definition of associate has been included in the SIP. So that includes now where a reasonable and informed third party might consider there would be an association, notwithstanding the nature of the association doesn't meet the definition of the insolvency legislation. And also it talks about how to deal with conflicting modifications. Some of the language has changed within the SIP as well, as you'll notice as you go through. Some of the words change from must to should, but also the phrase adequate time has been added to the proposed SIP on a number of occasions. It references allowing the debtor adequate time to consider the advantages and disadvantages prior to a proposal being issued, and also adequate time for the creditors to consider the proposal. But what one person's definition of adequate time is not necessarily the next. And the use of this phrase with reference to the latter, as in giving creditors adequate time to consider the proposal, doesn't actually appear to add anything on the basis that there are minimum notice periods prescribed in the legislation anyway. And then what? So if the change of pace in this year is so far is anything to go with, and the call for a whole a more holistic approach to be undertaken, forming the vast majority of responses in the DRO consultation. It's no surprise that a call for evidence on the whole personal insolvency landscape is actually on the cards. And again, if recommendations within the Woolard review are to be followed, and I see no reason why they wouldn't be, a review of all fees will be undertaken. This would include introducer fees and the entry fee to solutions. Now, we've all been expecting a tidal wave in terms of the need for debt advice for some time now. The extension of government assistance has prolonged this, but with furlough due to end, the cut to universal credit and increase to national insurance coming soon, it's likely we'll see an increase in demand. And to cope with that, technology innovation, I believe, will be key. We've already come away, I'd say, in terms of technology in the last 18 months. I'd never heard of Zoom 2 years ago. But in terms of insolvency and debt advice technology space, I suspect there'll be big things on the horizon. And hot off the press, the Insolvency Service published their annual plan on the 10th of September, providing confirmation that they plan to develop proposals to strengthen the regulatory regime for insolvency practitioners. And you guessed it, this will include consultation. To coin a well-used phrase, I'd encourage everyone when it comes to consultation to speak now or forever hold your peace. And that's all I've got time for today. If you've made it through, thanks for listening, and I hope you gained something from it. Thanks also to Neil Taylor Insolvency for the invitation to speak today.